Ben ritrovati lunedì mattina sul floor del New York Stock Exchange. Il rally della settimana scorsa sembra essersi interrotto quest'oggi, ma ne parliamo con il mio ospite qui sul floor, che è Kenneth Polcari, che è Managing Director per O'Neil Securities. Kenny, thank you so much for being with us.
Thank you for having me. It's always a pleasure.
So Kenny, I was going to say the rally. Last week we saw the S&P 500 closing on levels that it hasn't seen since 2007. It was a brilliant week, even though it was shorter than usual. This week seems that the rally has been interrupted already.
Well, I wouldn't be surprised, and nor should anybody really be surprised, because don't forget, on Wednesday, when we came back from the holiday, and there was all that supposed great news about the fiscal cliff, and the market gapped open big, right? So if you look at the chart, there's this gap left, and so that's one technical issue. Number two, the market got right to 14, kind of 50-ish. It got stuck there for a couple days, and it kind of chopped and churned. And on Friday, they tried to push it and test really the 2012 highs of 1475. I don't really think it's going to get there, but if it does, I would expect it's going to hit some resistance. And when everyone kind of sits back and digests the news, what did we really get last week in terms of this fiscal deal? We got higher taxes for sure, but we got nothing on the spending side. There's the threat of, the debt ceiling debate is coming up, the spending cuts are coming up, and then there's the threat of a possible another downgrade by S&P or Moody's, and so therefore that's clearly putting some, a cap on this rally as the market tries to digest and really understand, what it's going to look like going out. Tomorrow we start earnings season. Going to kick off with Alcoa. We already know it's going to be kind of a weak season. At least that's what they've prepared us for. And so as we go through, the markets will start to focus on individual names, but it's also going to focus on what's the tone of the talk going forward. What are companies saying about the next 6 months? What are they saying about their profit margins? What are they saying about the tone of business? And so that's clearly kind of holding us in check here at the moment.
And also, what do they say in terms of investment? Capital expenditure has been really low at the end of last year. Right. Consumers have been really cautious at the end of 2012. So they need to come back in order to have stronger earnings.
Well, they do. And listen, the retailing sector is a perfect example. We were right in the middle of the holiday, right? And everyone was talking about how great sales were going to be. In fact, you know what? Sales were great, but don't forget, they discounted everything, so margins got crushed. So that's right. And so what did all that really mean? Well, we already know that, we're kind of getting a negative story on the retail side. We're going to see when earnings come out, and that's what I mean about pressure on margins and what it really means going forward, not only in the retail sector, but across all sectors, what's happening with margins. And so the market's going to pay very close attention to that as we move in. It is looking for a reason to want to back off, as it should. Like I said, it needs to go back and fill that gap. So, move back down to 1425 or 1420 is not by any stretch a correction. No reason for anyone to worry about. It is a new year. There is new money. There is new asset allocation. Economists and strategists are talking about 2013 being a better year for equities overall. And so on any weakness, I think, people are looking to put more money to work.
Now, I have many points here. 2013, you were saying a lot of people are forecasting it's going to be a good year for equity. For 2012, we know already that all the calls have been completely wrong, right. Flat wrong, even the last-minute ones. Right. So, do you think that the market will be held hostage again from Washington until March, and then in March we can really make some forecasts?
I think it's going to be held hostage through March, April, right? Because my sense is, listen, they kicked this can down the road once in December or January 1st, whenever you want to say they kicked it down the road once. I'm not necessarily sure that anyone believes anymore that deadlines are really deadlines. Can they kick it down the line again? Can they just decide, it's a do-over and we're gonna find a way to, just move it down the line? So I'm not so sure that deadlines are really hard and fast, and so therefore I think you're going to, that we could be held hostage by DC, for the first half of the year. Potentially. The market does want to see resolution. The market does not want to see this continued uncertainty, because then we kind of get this purgatory that we're in, right? You don't see big volumes. And in order to see real commitment from investors and institutional investors, you need to see real volume. It's got to accompany, this move in the market. And so not just these trading volumes where, you've got shorts running for cover or people putting shorts out. You want to see real money. Real asset managers get back to work and put money to work, and that will signal, we'll get that signal when you see real volumes come back to the market.
Now, one of the certainly maybe it could be that the financial sector could be strong again. I mean, the Federal Reserve, of course, is helping. And we already know that even the fourth quarter is going to be kind of not too bad,
right,
thanks only to the financial. Now, Basel is saying, okay, you have more time, 4 years more to adjust to the capital level. So it seems that the financial is going to be another year for the financials.
Well, listen, even before Basel III, before they came out with this adjustment, you know, you could say they kicked that can down the road too, right? They gave them another 4 years to come up with the proper funding capital requirements. But the banks are a sector that we need to see lead overall. They've been talking about an improving banking sector anyway as the kind of global economy stabilizes and gets better. I think all that's true. But I think that yesterday's action in Switzerland with the Basel III rules is only going to add fuel to that fire, right? So the financials should act well. We saw in Asia and in Europe the financials acting well. We're seeing today the financials are overall, actually they're under maybe a little bit of pressure, maybe mixed, but overall, listen, they've had a good move, but people are bullish on the financials. So I would suspect that this year might be a good year for financials.
So we'll see. Anyway, we're going to focus on the earnings this week and not many economic data.
Right. There's no economic data today, and I do think as the week progresses, you know, the focus will shift to individual company earnings, as it should. But I think what will happen is, as you know, Washington continues to simmer kind of under the surface, that you know the conversation or the focus will go right back to kind of the broader macro picture.
Great. Thank you, Kenny, for being with us.
Grazie a lei.
Grazie a voi per l'attenzione.